Hello, everybody. What happens when you break the term of your mortgage? Well, you get a penalty. That's what we're talking about today on the episode of the Mainstream Mortgages podcast. And we have with us a guest today, Matthew Imhoff. He is an expert on mortgage penalties. So, Matthew, if you could maybe just describe to everybody who you are and what it is that you do so that they can get a better sense of who we have on as our guest today.
Awesome. Well, thank you, Derek. So I am the prepayment penalty mentor. I mean, I feel like I've kind of taken on this role to educate brokers and consumers when it comes to the mortgage return policies. And I was a broker for about 10 years, and I realized to have the biggest impact, I had to focus entirely on prepayment penalties. We have training, we have tools, resources to help brokers and consumers not only understand what the penalty is today, but where it's going to be when it matters most is when you actually return the mortgage. And we have over 500 subscribers in our program, Prepayment Penalty Mentor. And we're just about to launch our new product called OPM that will monitor and provide alerts throughout your entire database.
And is your prepayment penalty mentor program, who is that for? Is that for consumers? Can realtors sign up, or is it mainly just mortgage brokers?
I would say it's primarily mortgage brokers. We really incubated it in our brokerage. I was part of Team Borley Mortgage Architects and then through Mortgage Professionals Canada events. But it's interesting you say that. We actually, this past week, had five mortgage specialists sign up. So I don't know if they saw
Nice.
our ads or, maybe attended an industry event. Obviously, you want people to understand mortgages, but at the end of the day, if someone is trying to provide, better advice, better results to their clients, who are we to say how it gets in front of that client? Now, obviously, there's
Yeah.
certain things, people, if you're not an accountant, there's certain things, people aren't going to talk about. But at the end of the day here, we believe that the way that things have been set up is just to benefit the lenders, benefit the banks, and it makes it really difficult to actually make that decision of which product do I select, as well as which direction do I go, whether there's an opportunity or just life happens.
Okay, one more question before I hand off the next one to Peter. You mentioned that you had about five mortgage specialists sign up for your program. For anybody who might not understand the difference, what is the difference between a mortgage broker and a mortgage specialist?
Well, first off, for Manitoba, you're all called mortgage sales people.
Right.
A mortgage specialist would be someone who works for one particular lender, be it a bank or a credit union. Uh, Typically, I mean, they're only selling those products. I mean, they're on commission, but there could be like a salary component. They're getting benefits, through RBC, BMO, or whichever lender that they work for. So typically for them, I would say they shied away from knowing much more about other lenders, other products. So, you look at it, this obviously helps them with their own products. They could put in, their bank mortgages and kind of see the risks of the products they're selling, which is a great thing. But also having it where if they have that clients that maybe was working with a broker before, at the end of the day, if that consumer, that client finds out, information about their mortgage, who are we to judge if it comes from a mortgage salesperson, a mortgage broker, or a mortgage specialist?
Agreed.
I'm going to just jump in here because as the senior statesperson of our group, I've been doing this for 30 years, and mortgage penalties have sort of been like the least talked about, least understood item about a mortgage. And to be honest, maybe a dirty little secret, it would be fair to say. When you came out with your program, like I was one of the first ones to step up to subscribe because we've been dying for something like this to help educate our customers. So, what actually got you interested in prepayment penalties? Because each lender does it differently. The calculations are overwhelmingly complicated. So, what made you want to do this?
So I guess I have like two origin stories here. So the first one was, the theory that we're in a simulation, right? That we're living in a simulation. This is all formula, calculations, like everything here, right? And so I remember having it where I was like, if lenders like, oh, we can only quote a penalty for today. I'm like, well, but if you know, if you make the assumptions, you run the calculations, you can really calculate it for any point in time. And then I was like, well, then what's a payout statement? Right? A payout statement is a future quote, but they've locked it in. Why? Because you can't have it changing last minute. You can't have the lawyer say, hey Peter, hey Derek, hey Colton, like the penalty has changed. Why? Because yesterday this rate changed. Now it's 5 grand more, 10 grand more. So you look at it, these rules and kind of boundaries have been more to kind of protect the incumbent, protect the lender, have it where if I'm thinking of breaking up with the lender, I have to call them. And it gives them, that first mover advantage, either try to retain the client or, maybe jack up the costs, make some changes in order to charge the client more if they leave. So that was the first thing. The second thing was when I was a new broker, so back in like 2016, 2017. So, a bit after you, Peter, because you 30 years. What did you join when you were like 12? Like,
Four,
so
actually, it was four.
four. Okay,
Banking
exactly.
prodigy. Yeah.
Exactly. So I remember I'd submitted a deal to a local credit union. And I, for some reason, and maybe a lot of brokers think this, I'm like, got a really good rate, getting really good commission. And oh, they're a contract to contract. Like I don't see any posted rates. I don't see any discounts. And so what happened was I put a lot of clients there. I'm like, yes, it's low penalty risk. Why? Because I didn't see anything that made me believe otherwise. Now, if you're dealing with credit unions, and I think it's the same way in Manitoba, the client signs a lot of documents in branch that the broker or the salesperson doesn't see. Then they sign documents with the lawyer. And so I had it where I had these, 7, 10 clients that I sent there. And I told them something that was far from the truth, maybe out of ignorance and not having, connecting all the dots. And so I made a note of kind of what their penalties would be, some rough estimates. And I tracked it. And if they ever had a situation where they had to return it and it cost them, say, 2 grand or 5 grand more, my intention was to go and make them whole. Because it's not their fault that I put them towards a product that carried more risk than that they were expecting. Like, fortunately for me and fortunately for them, they, finished their terms. But you look at it, if it's a credit union, you know a lot less about it because you don't get all the pieces. If let's say you're submitting it to TD Bank or Scotia, the broker might not look at the documents that are in front of the lawyer and the client, right? They might have never looked at those documents. And then also to kind of complete the information picture, after closing, the client received what's known as like a welcome package or a confirmation letter. Well, there's details in there that if you don't have, you're behind the game when it comes to understanding where that mortgage started and where it's progressing, not only from a payment and interest and balance point of view, but also from a penalty perspective. And so that's where, with our training and our expertise, we try to get you to understand the product that you're selling and how it evolves over time. And so the analogy I would love to use here is, so I'm sure all of you have flown like WestJet or Air Canada before, right? If you book the cheapest fare, what are you getting besides not being able to bring a carry-on bag or check a bag? You can't make any changes, right? So what happens here is you get a lot of people either selling or buying mortgages or getting mortgages, and they get that basic fare. And they're like, oh, yeah, I want to sign up for a flight tracker. Why? Because if the price drops, I want to switch to it. And the reality is there's a lot of mortgages people are getting that it's unknowing to them that it's pointless to sign up for a flight tracker. Why? Because that penalty is always going to be bigger than what you could save replacing it with a new product. And so at the end of the day, if that consumer can accept the risk of buying that product, oh, my rate is 0.1% lower, then it's less about saving the money by jumping to a new product midterm. It's more about mitigation, right? It's more about, oh my gosh, we're having twins, we need to move to a bigger place. The lender won't port the mortgage. It just comes down to, at the end of the day, it's brokers and salespeople need to do a better job of explaining the products that they're selling and understanding them in order to manage the client's expectations.
kind of rolled right into my next question, to be honest. So I think it's interesting because I just had this conversation a week or two ago where a client asked me why would there be a penalty for breaking my mortgage term. And so my question to you is, and you kind of alluded to it, what is the does the problem lie with us as brokers, or maybe the client's not understanding of what these prepayments are, or um, just why they're not understood?
I think a big part of it is, so first off, we're not thinking about returning the mortgage the moment we give someone the mortgage or get the mortgage,
Mhm.
right? If someone takes a fixed rate, they're betting that rates are going to stay flat or go up. Okay. And so the 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 best way to look at it is like this. So let's say you were selling someone, let's say a 4% 3-year fix. Okay. If the rate that they're being compared to is always 4%, the interest rate differential is zero, and you'd pay 3 months interest. Okay. You typically need to get a rate, I would say maybe 3.5, like, or a little bit lower, to justify paying the penalty 3 months interest at 4% to jump to the new rate. Okay. So what happens here is, and so I'll give you like a bank example. So you give that client the 4% 3-year fix. Obviously, the first 6 months, unless you see rates drop and that penalty stay low, there's nothing that's going to make sense. But what the banks have baked in, and they don't really want you to know, is that after 6 months, they're not going to tell you that they can earn 4%. They're going to tell you they can earn, I think it's something like 3.15%. Okay. So we fast forwarded 6 months. Let's say rates come down a little bit. You're like, okay, client, I can get you a 3.5. But if they're charging a penalty based on 3.15, then that penalty is bigger than what you can save by jumping to a new product. And so if I look at this, so if they're charging me an interest rate differential based on 3.15%, that's roughly my break even rate. If you can't get me a rate lower than 3.15% or solve some other problem, there isn't enough value to justify returning that mortgage, paying that penalty, and jumping to that rate. Okay. So that's the big thing here. It's, if you look at it from the lender's point of view, penalty, right, plus the 3.15 that they're lying about if they're the bank, equals 4%. And at the end of the day, they don't care which path you go, but that bigger penalty locks you in and keeps you in that mortgage longer than what you're hoping or what you're expecting. So it just comes down to it, where we'll see situations, and we saw this like last year, was if the banks didn't adjust certain rates, you could have situations where you had like a 5% fixed rate mortgage with 3 years left, penalties 3 months interest, but now you're getting them like a 3.79. Okay. So it's like in that situation, the penalty is lower than it should be, meaning there's value fee escape. The penalty is bigger than it should be. You're either stuck or you have to have some other problem that is worth paying that premium in order to go through and move. And so we look at it with our forecasting, is we want to look at what it is today, but the entire term, and then allow you to determine the best spot, the best point in time to maximize the value by returning that mortgage and moving to something else.
That makes sense. So, Matt, you mentioned before that banks don't like to quote penalties for a future date. They only say, "Oh, I'll quote you something for today." Why is that? Like, why is it that the penalty can change from one day to the next?
So let's look at the easy things. So one, the balance. The lower your balance, typically the lower your penalty is. Then also there's the less interest that you would owe to the end of the term, and then it's the rate that you're being compared to. So if, let's say, I have that 4% rate, I'm being compared to 4%, interest rate differential 0, penalties 3 months interest. Okay. I make a payment, my balance drops, 3 months interest a little bit less. I travel through time. Now I'm being compared to a different posted rate. They say they can get 3.15%. Now I have a big interest rate differential. So it's partly to cover them, but it's also to make it difficult for people to make decisions today based on like where things are projected. Like they will quote your penalties 3 months interest today, even if tomorrow it's set to double or triple. Okay. So the idea is, and then also gives them advantage. Like if basically for them, you're the one needing to do something. They have the information, but it's beneficial to them, kind of like the less you know, as well as it would cost them a lot of resources to do these forecasting and stuff like what we're doing. Okay. It's like, and you have it where it's like the fear of the unknown. Hey, maybe I just accept what my bank's offering me because, oh, my friend so and so, their penalty doubled in a week and they're saying I can pay this and jump to this. So you almost focus on kind of that safety net of like a quick decision, a quick results. Whereas for here, and why our tools can be really helpful is you get that client, they get the penalty quote, it's 3 months interest, right? And you confirm it with the tool, but you see in 3 days it's set to double. The math doesn't work based on that. And I can't get anything done between now and 3 days. You just let the client know, like, I'm sorry, it's too late. I wish we had spoken 2 weeks ago, 3 weeks ago, versus there's brokers that will rush and get everything done only for it to fall apart when you actually get that payout statement. So you look at it, it's by them just focusing on the quote today, they're accurate, it's less work for them, and it ultimately makes these lenders more money because that client is kind of on high alert in terms of how things might change. And they just don't venture too far away from that lender, right? The analogy I like to use is it's like if you didn't know where you lived because you didn't have all the information, you would never leave your home. These clients don't have all the information unless they're working with brokers with PPM. So a lot of times they just stay where it's safe, where it's known. They don't venture away. And the lender's not going to go out of their way to tell them if their penalty is lower than it should be or significantly higher than it should be.
So, like, now I'm gonna go buy a house. I'm a consumer. I'm not very well versed on mortgages. It's like maybe my first home or my second home. I'm working with my realtor, and my realtor is giving me recommendations on where to get the mortgage done. Um, why should they maybe focus on a broker instead of a bank or credit union from a prepayment penalty perspective?
I mean, it comes down to it. If you go with that bank and you want a fixed rate mortgage, you're getting the payment certainty, but you get the penalty uncertainty, as well as you're getting someone who there's really no benefit to them to be proactive. They don't manage those mortgages after they fund. You deal with the branch. And so I look at it, you might get the lower rate, but you don't necessarily know about the risk. And so I look at when it comes to the penalty, it's like the deductible on your car insurance. Okay. You might be a really good driver. You're going to drive your mortgage to the end of the term. But at the end of the day, you want to know if your deductible is 500, 1,000, 2,000. You want to be able to compare this and you want to have your expectations clearly defined. So I look at it, you go to the bank there. They're not telling you that 3-year fix is that WestJet basic fare. They're telling you, yeah, if rates tend to stay flat or go up, your penalty is 3 months interest, which is a lie. It's baked in after 6 months, 7 months with RBC. That penalty set to spike unless the 2-year posted rate goes up. Now, since they're not forecasting beyond today, they can't see that danger. So if you're like, well, we might sell or do something in a year, whereas if you go with that broker or the salesperson, one, they have other products where if rates stay flat or go up, the penalty is guaranteed to be 3 months interest in 6 months, a year, 2 years. And then also they have the ability to kind of track this for you using PPM. I mean, now I know a lot of mortgage specialists are signing up. So maybe by the time people are watching this, we have, 50 mortgage specialists that signed up. But at the end of the day, most likely that mortgage specialist knows less about penalties and less about their product penalties than brokers who aren't even selling those products. So I just look at it. It's, do you want to pay less for a product that carries more risk that's not really explained to you, or would you rather pay a little bit more for a similar product that's explained to you and tracked and you know what to expect and how to mitigate your penalties because you have that support, or you choose the product that provides you with the most value? Like the fundamentals here are, it's not about whether you finish the term or not. It's about choosing the product that provides you with the most value, or choosing the product that, yeah, if rates go down, I might want to pay a little bit more for a product that I can pivot to something else. Or, if I want a variable rate, or I want this, it's really what we're trying to go and do here is not scare people away from bank fixed rate mortgages, is to have it where they understand their decision and they're more inclined to update their broker about how things have changed. So that if we need to make a pivot, we do it at the point in time where the costs are the lowest. Okay. So I look at it, sure, you can go to the bank. Now, a thing to be concerned about here, and I would definitely talk to your realtor about this. Sometimes the banks pay the realtor, right? And so maybe they're pushing towards that RBC or, CABC person, but they're getting Avion points. They're getting $500, they're getting 1,000. So it's very important that you ask, what are you getting from them? Because they might not be doing it because you're going to get the best rate or the best product or service. They might be doing it because they want to make a bit more than their commission. And it's just, at the end of the day, it's better off that they're working with a mortgage salesperson where they're just providing good value by referring someone. And I always believe a referral is an extension of yourself. Okay. At the end of the day, you refer someone because you know that they're going to be accountable, be very good at what they do, versus, oh, I get Avion points. Oh, I get $1,000. And at the end of the day, whether you end up going with the bank or whatever you end up doing, you need to be talking to a broker. You need to be talking to a salesperson.
And a follow-up question. Are you a fixed person or a variable person?
It's interesting. I was actually interviewed on this a couple of weeks ago. I don't like stats that go and say like, oh, this number of people break their mortgages and whatever. Because part of it with that is there was a period of time where penalties were far lower than they should be. In fact, we had it with TD Bank. There was like a 2-year period. Everything was 3 months interest.
Yeah.
So if you took that 6% 5-year in, fall of 2023, you're actually making the wrong decision by remaining in that product versus returning it. Okay. So I look at this, it's, and even if like a mortgage salesperson or broker says to the client, well, I'm in a variable, it's disingenuous because you know so much more about their personal financial situation. They know very little about yours.
Mm-hmm.
So why would you go and push that? I think a lot of brokers push variable because it's easy to understand, penalties. And at the end of the day, it's not about pushing one thing or the other. It's about helping the client select the product with the most value and understanding whichever products that they, that's offered to them. And so if I have a client that comes to me and they say, I want this RBC 3-year fixed, I'm not trying to convince them variable. I'm trying to compare them to the product that's closest like that. And what's closest like that is a TD or a Scotia 3-year fixed because they get me. Now I don't broker anymore, but I'm saying like brokers that are penalty experts understand this. No. Yeah, exactly. Peter, right? And then at the end of the day, they're like, oh, well, we want a fixed rate, but we might sell in a year. Well, okay, well, let's look at like an MCAP 3-year or a First National 3-year or, a RFA or whatever, right? And they're like, okay, well, but that's, $40 a month more. And we're kind of projecting, we're like, well, in a year with TD or RBC, your penalty is going to be about $8,000. Here I'm projecting $4,000, which if we add everything up, you're $2,000 ahead with this versus that. And so the idea, it's not about just swinging the pendulum the whole other direction. It's about listening to them and figuring out where we can provide the most value. And the thing about this is, and the analogy I like to use here is like we're at, is there still the Regent Casino, right?
Yes.
We're at the Regent Casino, right? And we're roulette specialists or roulette salespeople or whatever. And we have clients that want to bet black and clients that want to bet red, like fixed and variable. Well, what are we cheering for? Because if we have clients on either side, we can't be seen cheering for one or the other. At the end of the day, we just have to explain the risks of the products and make sure that they can, that they can afford to lose that, that they probably be better off going outside and flipping a coin, but, at least you can get drinks inside of Regent there. But it's about them understanding about how they win and how they lose and remove ourselves from it. Because you see so much where brokers are kind of invested with whether rates go up or down. You really have to work where you're in an environment where no matter what happens, you're providing expert advice and you're constantly reevaluating. That client takes the variable. They know to reach out to you before they lock in. Why? Because you want to do a penalty assessment. You want to make sure that it's not an idiot move of locking in that variable and then selling in a year when we know about the spike with TD, RBC, BMO, whatever, right? Because there's people that do that. Why? Because they want to stop the bleeding and it ends up costing them a lot more in the future. So my answer is it's about determining the product that provides the clients with the most value and constantly reevaluating and just understanding how they would feel in a variety of scenarios. You choose fix, rates go down, how are you going to feel? What can you do with that product?
Matthew, is there anything about prepayment penalties that we haven't spoken about yet today that you believe is extremely important for either borrowers, realtors, or other mortgage brokers to hear?
Well, so one of the things we're working on here is it's so if you get a mortgage, right, you get your mortgage amount, your interest rate, you have your path in terms of your principal, especially if we're dealing with fixed, right? Your principal, your interest, your balance, and right. So obviously, like a cost of borrowing is pretty powerful. Like you can see the path. Sure, you can speed things up and you can slow things down to a certain degree. Then you do one for variable, and you're kind of like, why am I doing a cost of borrowing or amortization summary for variable? Because you have no idea where it's going. And so the idea here is for like a fixed rate mortgage, and what our tools can do is we can forecast the entire term and we can give you some expectations. But also we can kind of translate to be like, what's the lender telling us? So like the bank example. The first 6 months, they're telling you they lent you the money at 4%, they can get 4%. Interest rate, you don't owe them anything because they're getting their full amount, but you still pay them 3 months interest. And then, if you have that client that's like, well, Matt, what would have to happen for my penalty to be $5,000 or $10,000? And since we were hyper focused, we can basically reverse engineer. We can say, in 3 months, they'd have to lower this posted rate by 0.7% and your penalty's $10,000. Or if we wait 7 months and we're compared to here. So really we liken it to kind of knowing what to expect from both an interest rate balance perspective, but as well as like a cost to return. And it's not about whether you want to return or not, but just if for some reason you're thinking of doing something, you're applying for a job, overseas or whatever, it's nice to kind of know what it's going to cost you to make the ultimate decision versus having it where you're almost set in what you're doing regardless of the cost. And I think the biggest issue here with penalties is the disconnect, the everybody always talks about the low rate. Oh, I locked in a 10-year, I locked in this, like the cooler, water cooler talk. When people pay big penalties or stay in a mortgage longer than they should, they don't really talk about it because they're a little bit embarrassed, right? So what I find here with this is we want people to really understand where they're at. And we want to make sure, like a big part of what we're doing with our tools is just tell better stories about that mortgage, whether it's a good story or a bad story, and just have it where because the broker is dialed in, that client is willing to share more, right? Hey, there might be layoffs. Hey, there might be this. Hey, we want to sell. Because what I find, what happens a lot is that you do a mortgage and you say it's just not just a transaction, but it kind of is because you don't really stay in touch with the clients and they don't really stay in touch with you. And so having it where they kind of understand this decision and realize like, hey, they're going to send you a welcome package. Send that to me so I can lock in this value to confirm your details. Hey, I'm going to remind you about your prepayment privileges. Hey, I'm going to give you a heads up if there's an upcoming spike or decrease when it comes to your penalty. You got to tell me if you incur a bunch of debt. You got to tell me if you might lose your job or move for work or, you get having a bunch of kids or the kids are moving out because they're 18. Like you kind of want to be working together here, not because you made the right decision at the start, but so you can make the best decisions at any moment in time. And, how great is it for you if you have your database where people are updating you And if you have that opportunity and there's a 1 week window, well, I can convert it. Why? Because I know exactly what I need to go and do versus, hey, it's too late. It's too late because we only got all the information today. So I would say with this, it's brokers can provide a lot of value, even just by kind of running these calculations. But if you have a client that sees the value of paying a little bit more upfront for a lifetime of savings, then working with a broker or salesperson that has our tools, Prepayment Penalty Mentor and OPM tool that's coming soon, you're gonna have so much more protection and security that I don't think you'll ever go back to just dealing with the bank directly.
And that's, I think, a great note to end it on, Matthew. Can you
Yeah,
please tell everybody where they can go to investigate your prepayment penalty mentor program in further detail?
absolutely. So our website is www.penaltymentor.ca. So right now we have, if you're an MPC member, and a shout out to MPC, like I wouldn't be here today. And I think, Peter, we met like at MCC conferences and stuff like that. If you're not an MPC member and you're a broker, you got to join. Like it's such a collective sharing information. And also when it comes to our tools, you're getting $10 off per month. Our lowest tier is our penalty calculator. That's $10 per month if an MPC member, $20 a month if you're not an MPC member. We have a refinance comparison tool, so 40 or 50. And then what we're doing is we're actually onboarding our power brokers in our top tier that pay around $100 per month. And we're taking their database from whatever submission platform and plugging it into OPM. And we're spotting tons of opportunities and really good touch points where you're like, hey, client, I can't really save you a bunch of money, but if you value lowering your payments by $400 a month, well, maybe there's something that we can go and do. So it just comes down to, because there's so many calculations going on, having clean data, we can really tell you, where you're at and where you're progressing, and then have it where there's as few surprises as possible, because nobody wants to get that payout and see the penalty is double than what they thought it would be. Nobody wants lawyers calling them saying there's a shortfall. I think I remember when I was brokering, if I never talked to the lawyer on the file, it was a good file, right? And also too, is last thing you want is the client coming to you and saying, hey, Peter, I'll do this, but you got to pay half the penalty, right? And when the deal is pretty much done, I like to say that they're holding your commission hostage. Why? Because they don't need to refinance or do whatever. So you need to do a very good job of explaining, managing their expectations. So if something happens, it's something that you foresaw and something you're not blamed for.
Thank you so much for your insight today, Matthew.
Perfect. Well,
And
thank you
thank
for
you.
having me.
Yeah, thanks to everybody who's listening. If you want more information, obviously you can reach out to Matthew and investigate his prepayment penalty mentor program, or you can talk to us at Mainstream Mortgages 431-482-2187, or email us at greatrates@mainstreammortgages.com. Have a great day, everybody, and thanks again, Matthew.
Thanks.
Thank you.